People look in
Mm,
hindsight, well, why didn't you press it there? The market went up, or, it had already bottomed. Well, that's all well in hindsight, but you have to manage risk in real time. And the thing you learn over time is that number one, risk has to be managed. The only way to avoid a big loss is to take a smaller loss. And it has to happen in real time. So is you would, and the thing that someone like myself has to guard against is becoming thinking something and thinking, and I find that, individuals that even just first get started with this, they have a good run and then they start thinking they know something, and you start forgetting about rules, and you think you can hold a stock, it's down, the company, oh, it's Nvidia, it's not going out of business. When you start saying things like, well, the company's not going to go out of business, you're right there, you're in trouble. And when those words start coming out of your mouth, your trouble is coming somewhere in the future. So yeah, and so we're bending, with the market, and we're a caboose. The market's the engine, and someone even like Bill O'Neill, who had tremendous, tremendous success, was so when it came to the market. And Bill wasn't exactly the most humble guy if you talk to him, but when it came to the market, he was. When it comes to the market, we're pretty humble, and that's really the key.
It seems like a lot of what you talk about all comes back to having that discipline, which you've learned over the different market cycles that you've participated in. So, how do you really avoid that fear of missing out when you see high octane stocks that have doubled off their lows or recent IPOs that are just going bonkers and really focus on what you do best?
Yeah, what could because you have to stay in process. You really just have to stay in the process. And when the stocks are meeting your criteria, you're buying them. And if the market is so good, if the environment is so good, then your results from those initial buys should be profitable and not having a lot of trouble. And I call it the reward to aggravation level. The reward to aggravation ratio. I didn't get in the market to get an ulcer, so, and there are periods of time that you could very easily get an ulcer if you're in there trading large, and, money can make you sick. With the market has caused a lot of problems for people, even health wise. And this is why I never get myself into that situation because I'm out. The stock's moving against me, but I stay in process, and I only get big. We talk about this a lot. Mark Ritchie, my assistant, he came up with the slogan, "Earn your right to play larger." Earning your right to play larger. Like we never play larger unless we earn our way to that. Earning that means that our initial positions have to be showing progress and traction before we're ever going to get larger. So, because why would I add money if things aren't working? It's not even, O'Neill used to say, if you're not profitable at 25%, why in the heck would you ever go to 50 or 75? It just doesn't even make any logical sense. That's guessing, that's forecasting, as opposed to responding. We're in the response business. The only difference I think between Mike and I, he and I'm really quite curious. I meant to ask him a while ago because I saw some of these rules for the S&P, and I love these rules. I call it a lockout rally. When the market is moving up into what he calls a power trend, I call it a lockout rally where the pullbacks are very small. They're usually 1, 2, 3%. It just keeps moving higher and higher and higher, and you keep feeling like you missed it and never pulls back. And even when it does, maybe it's 5 or 6%. And we can get into those markets, but stocks don't necessarily set up in the fashion that I would be willing to load the boat because the risk is still high on the individual stock level. The only difference is that once stocks start meeting the criteria, and let's just say I'm getting that traction and my stock positions are working and they're breaking out of bases, if the S&P started getting a bunch of distribution days and rolling over, if my stocks aren't getting hit or they're not showing the volatility, I usually stay with the positions. But I might tighten my stops. I might start taking some profits on extended names to offset maybe what looks like could be some volatility coming down the pike in the next few days because the indexes started getting into trouble. So I will tighten up a bit, but I'll still defer to the stocks. I'm really deferring to the individual stocks, even around bottoms. The market's in a bear market. Even before we get a follow through day, I'm looking for stocks that maybe are already breaking out of bases right off the lows. So I'm always deferring to the stocks. I'm very much bottoms up.
So, how did you develop that discipline, Mark? Is it just looking at charts,
Losses
studying?
and getting your fanny whacked, early on. One, I tried every other way, and there really isn't another way. O'Neill said that. I heard him say it many times, where, there isn't another. The only way to avoid a large loss is to take a small loss. And if you start forecasting and trying to predict, I realize that I'm just not that smart. As long as I've been doing this, I'm still just not that smart. I don't know if anybody is, but it just, yeah, it's not something that you could rely upon. These are rules that I could rely upon. They keep me out of trouble. And so here's another important thing. Your system, any system that you use, if it's really a good system, it'll do two things. It will automatically force you to be trading your smallest when you're trading your worst and trade your largest when you're trading your best. There needs to be some mechanism because otherwise you're going to be thinking, well, the market ran up too much, things are extended, and you start selling stocks, and now you just sold your stocks into a bull market. Or the market's a pullback, well, it's a short-term pullback, things still look okay. This Nvidia, I'll double up here, and now you've just loaded up into a bear market. So my strategy and the way I approach things is that I'm just forced into the market when it's doing well, and I'm forced out when it's not doing well. And if it's whipping all over the place, that's the worst environment. That's the one that I avoid at all cost. Like a bear market, a market that's going down sharply, that's the easiest one. You get knocked out of everything, nothing's setting up. There's distribution in the market. It's an easy call. The opposite, everything's working and everything's breaking out, and that's when everybody's happy, right? That's easy call too. It's when you get into a market like now, and this is where, like, if you're managing money, this is the worst possible position when the indexes are going up and you're in cash or you're losing money, and then everybody wants to fire you, and so, but that's the discipline, and you have to stick with the discipline. So it's just, I have 43 years of doing this. I learned my lessons in the first 6 years, and for the first 6 years, I didn't make any money. I was actually at a loss after 6 years. And then from that point forward, I only had three down years in 30 some odd years. So, and all single digits. So those are the lessons I learned. And then I made a change and applied them forward. And I have found that over the years, I don't really need to use big leverage. Maybe on rare occasion, I don't need options. I don't need to pick the low in the market. I don't need to be invested right away as the market goes into a new bull market. All these things I found to be unnecessary. They were all concerns and worries that really didn't mean anything. So it's just, if it's necessary, if you're a short-term trader and that's how, like as Mike said, you find your own way, your own style. And if our style makes sense to you, great, adopt it, use as much as possible, because why reinvent the wheel? But you're certainly going to adopt, some people are much shorter term oriented. I'm somebody, I cannot hold losses. My stomach just bleeds from from losing money. I don't like to lose any money. So that's why I've come up with a very, risk adverse, and on the shorter term, I always say, look, I'm not against holding stocks. I'm against holding losses. If once you're at a profit, if you want to move your stop to break even and put it away for eternity, that's fine. As long as it stays above my stop, I'm fine with that. So if you're gonna, that's where, short-term trade the losses, long-term trade, or long-term hold the winners, and then if you want to trade around positions, fine, and reduce your risk into strength. Sometimes if things are really too comfortable, that's not the right move.
Yeah.
Yeah, you have to learn to. That's one of the things when you learn that you're become a competent trader is in the beginning when you first start trading, everything you think you should do, you shouldn't. And when you're scared to death, you should be buying. But then there's a crossover that happens. Like your gut actually starts to become right, and you have to start listening to it. That's when you've achieved competence as a trader, where now when you're scared, you should be scared. It's a tough it's a tough thing because, when does that happen, and when does that crossover? That crossover doesn't usually happen for a while. In the beginning, you've got to do a lot of things that are very uncomfortable. This stuff is not uncomfortable for me anymore. It's uncomfortable for me to go against my rules, but and it's uncomfortable for me to hold a stock that's down. I'm not worried about whether it's going to turn around and go up. And I talk about this many times, but the real fear, reason why people don't cut losses is because there's the fear of being wrong twice. See, the first time when the stock rolls over and you take a loss, you're admitting defeat. No one wants to lose money, right? You built this big case, and in 2 days, next thing you know, you got to sell it. So that's uncomfortable. You don't want to lose money. But the real fear, the real reason why people, and this is where the ego comes in and you got to get rid of it. The real fear is that the stock's going to turn around, it's going to go back up, and you're going to regret that. And you're going to be like, damn, I knew I should have held it, because you've seen so many do that. And now that's your real fear, is that you're going to be a double dummy, right? And so, but yes, that's going to happen. But here's how you get around that. You have to manage risk in real time. You have to realize that that's only clear in hindsight. In real time, we don't know what the next card coming out of the deck is going to be. So we have to respect that, and we have to bend with it, because risk has to be managed in real time.